The illusion of certainty. Why traders seek certainty. Every trader, whether a beginner or a seasoned professional, enters the markets with one underlying desire: certainty. The dream is simple. Find a way to predict market movements with enough accuracy that losses are minimal and profits are nearly guaranteed. It's a natural human instinct. We are wired to search for patterns, explanations, and assurances. When you put money on the line, this desire multiplies. After all, money represents security, freedom, and survival. But here lies the first psychological trap in trading: the belief that certainty exists. The truth is that the markets are inherently uncertain. No matter how much analysis you perform, no matter how many indicators you study, and no matter how much news you consume, you cannot know with absolute certainty what will happen next. A stock, currency pair, or commodity might look poised to rise, and then suddenly it collapses. It might look ready to collapse, and instead, it rallies. This unpredictability is not a flaw of the market. It is its very nature. Traders who cling to certainty often fall into destructive cycles. They hesitate to enter a trade because they don't feel sure enough. They exit too early when doubt creeps in. They hold losing trades longer than they should, hoping the market will prove them right. They constantly search for the perfect system, the holy grail that never loses. This obsession with certainty creates fear, hesitation, and inconsistent results. In contrast, consistent traders accept uncertainty as a permanent part of the game. They don't seek to eliminate risk. They seek to manage it. Probabilities versus guarantees. Think about a casino. Casinos do not know the outcome of any single hand of blackjack or any single spin of the roulette wheel, but they do know the probabilities. The odds are structured so that over thousands of plays, the casino will make a profit. The casino doesn't panic when a player wins a jackpot because it knows that its edge guarantees profitability over time. Trading works the same way. No trade can be known in advance with certainty. But if you operate with a reliable strategy, manage risk, and think in terms of probabilities, you can achieve consistency over a large number of trades. Here's a mental shift. The losing trades are not failures. They are simply part of the distribution of outcomes. The winning trades are not validation of your ego. They are simply part of the probability curve. When you understand this, you stop obsessing over whether a single trade will win or lose. You begin to think like the casino, focused on the edge, not the outcome of each individual play. This probability mindset is the foundation of trading psychology. Without it, you are always chasing guarantees, and guarantees do not exist. How fear controls decisions. Fear is the emotional byproduct of the search for certainty. When traders are afraid, they hesitate, second-guess, or sabotage themselves. Fear can manifest in different ways. Fear of losing money. You don't take trades when you should. Fear of being wrong. You hold losing trades longer, refusing to accept a loss. Fear of missing out. FOMO. You chase after trades late, entering at bad prices. Fear of giving back profits. You exit winning trades too early. Fear is essentially a response to uncertainty. When your mind demands certainty but the market only offers probabilities, fear fills the gap. The solution is not to eliminate fear, but to reframe how you think. If you train yourself to fully accept the risk before entering a trade, fear loses its grip. Once you accept that you might lose and that it's a natural cost of doing business, you can focus on execution instead of emotion. The market's neutral nature. Markets don't care about you. One of the most difficult truths for traders to accept is this: the market is completely neutral. The market has no memory, no agenda, and no bias for or against you. It doesn't know you exist. It doesn't know you are entering a trade, nor does it care whether you win or lose. Yet most traders behave as if the market is somehow conspiring against them, punishing them for mistakes, or rewarding them for good behavior. Here's an example. Suppose you enter a trade and the moment you place it, the market moves against you. Many traders take this personally. They think, why does this always happen to me? Or, the market turned as soon as I entered. It's like it's watching me. This is an illusion. The market didn't turn because of you. The market turned because countless participants, institutions, hedge funds, retail traders, high-frequency algorithms, were all interacting with each other at that exact moment. Your position is like a single drop in an ocean. The sooner you accept that the market is neutral, the sooner you free yourself from the emotional roller coaster of trading. Objective versus subjective thinking. Most traders enter the market with subjective thinking. They view each movement through the lens of their own expectations, fears, and desires. For example, if you're desperate to make money, every bullish candle looks like an opportunity to buy. If you've just taken a loss, every bearish move feels like a personal attack. If you're overconfident from a winning streak, you see confirmation everywhere that you're right. This subjective lens distorts reality. You're no longer seeing the market as it is. You're seeing it as you want or fear it to be. In contrast, objective thinking allows you to step back and view the market as neutral information. A candlestick is just a candlestick. A trend is just a trend. The market doesn't care whether you interpret it as good or bad. Traders who operate objectively treat market data as raw input. They don't get emotional when the market moves against them because they don't assign personal meaning to it. Their job is not to control the market, but to respond to what the market actually shows them. This objectivity is a skill, not a natural talent. It requires training, practice, and a willingness to detach your ego from your trades. Detaching emotions from market moves. Imagine two traders looking at the same chart. A price breaks through resistance and pulls back slightly. Trader A feels fear. He thinks, what if this is a false breakout? I'll lose money again. He hesitates, misses the move, and feels regret. Trader B feels confidence. She thinks, my system says this breakout has a 60% chance of continuation. I'll take the trade and manage my stop. She enters, accepts the risk, and executes without hesitation. Same chart, same data, two entirely different emotional experiences. The difference is not the market, it's the trader's mindset. When you attach emotions to market moves, you make decisions based on fear and greed rather than logic and probability. When you detach emotions, you make decisions based on your system, edge, and risk management. This detachment doesn't mean you stop caring about outcomes. It means you stop letting outcomes control your behavior. You still care deeply about being consistent and disciplined, but you no longer let a single trade dictate your self-worth or confidence. The market as a mirror. The market acts like a mirror reflecting your inner world. If you are impatient, the market will test your patience. If you crave certainty, the market will expose uncertainty. If you are greedy, the market will punish overconfidence. If you are fearful, the market will magnify that fear. Every weakness in your psychology eventually shows up in your trading results. This is why some traders repeat the same mistakes over and over. The market is not punishing them. Their own beliefs and emotions are. When you begin to see the market as neutral, you also begin to see your trades as feedback about yourself. Each loss or mistake is an opportunity to learn about your mindset. Instead of blaming the market, you start asking, what in me caused this reaction? This is how trading becomes more than just about making money. It becomes a process of self-discovery and personal growth. The mindset of a consistent winner. What makes a consistent winner? Different. In every profession, there are average performers, and then there are the few who excel. Trading is no different. The majority of traders struggle, moving in cycles of gains and losses, while a small percentage achieve consistent success over time. The question is, what separates these two groups? The difference is not necessarily knowledge. Many losing traders know just as much about technical analysis, indicators, and strategies as winning traders. Nor is it access to information. Modern technology gives almost everyone real-time data, advanced charting tools, and endless market commentary. The real difference lies in mindset. Consistent winners think about the market differently. They approach trading not as a battle to be won or a puzzle to be solved, but as a probability game. They don't need to be right all the time, and they don't attach their self-worth to individual trades. They understand that success comes from discipline, risk management, and emotional control, not from predicting the future with perfection. Their mindset allows them to act decisively without hesitation, accept losses without emotional damage, stick to their trading plan even when emotions tempt them to deviate, focus on the bigger picture rather than obsessing over individual trades. Discipline over prediction. Most struggling traders believe that the key to success is predicting the market correctly. They think, if I can just find the perfect indicator, the right news source, or the flawless strategy, I'll finally win consistently. But consistent winners know a secret. Prediction is overrated. No one can predict the market with certainty. Even the best strategies and systems will produce losing trades. What matters is not prediction, but discipline. The discipline to wait for valid setups according to your plan. Accept the stop loss without moving it. Take profits at your target instead of chasing more. Avoid overtrading when emotions are high. Discipline turns an average system into a profitable one. Lack of discipline destroys even the most powerful system. Think about it like this. Casinos do not predict which spin of the roulette wheel will win. They simply follow the rules of probability, apply them consistently, and trust the math. Traders must do the same. Thinking in probabilities. This is one of the most important mental shifts in trading. When you think in probabilities, you stop judging yourself by the outcome of individual trades. Instead, you evaluate your performance over a series of trades. A single trade is meaningless. It's just one event within a larger sample size. Here's an example. Suppose your trading system has a 60% win rate. That means over 100 trades, you expect around 60 wins and 40 losses. But those wins and losses will not come in perfect order. You might lose 5 times in a row, and then win the next 8 trades. If you judge yourself after each loss, you will feel like a failure. If you judge yourself after each win, you feel overconfident. Both are dangerous. The consistent winner says, this loss is part of the game. This win doesn't make me invincible. What matters is how I perform over the long run. By thinking in probabilities, you free yourself from the emotional roller coaster of short-term results. Detachment from outcomes. Consistent winners are detached from the outcome of individual trades. This doesn't mean they don't care about making money. It means they don't let one trade affect their mental state. For example, if a losing trader experiences a big loss, they might double their position on the next trade to make it back, hesitate to enter the next valid setup because they're afraid, question their system entirely, and start looking for a new one. The consistent trader reacts differently. They say, that was just one trade. I followed my plan. The outcome doesn't matter. I did my job. This detachment is a form of emotional maturity. It comes from deeply accepting uncertainty and risk as unavoidable parts of trading. Belief systems and trading. How beliefs shape trading behavior. Every trader enters the market carrying invisible baggage, beliefs. These beliefs are formed from childhood experiences, cultural conditioning, education, and personal encounters with money, risk, and success. Most traders never stop to examine these beliefs, yet they influence every decision at the trading screen. Consider 2 traders watching the same chart. The market dips sharply. Trader A believes that losses are dangerous and must be avoided at all costs. He interprets the dip as a sign of doom, panics, and sells at the worst possible moment. Trader B believes that the market moves in cycles, and that dips are opportunities. She interprets the same move as a discount and looks for an entry point. Same market, same chart, same data. Different beliefs, different actions, different results. Beliefs act like filters. They determine what you notice, how you interpret events, and how you respond. If your beliefs are empowering, they support consistency. If your beliefs are limiting, they sabotage you. Common limiting beliefs in trading. Many traders operate under beliefs that actively work against their success. Some of the most common include, "I have to be right to make money." This belief creates pressure to predict the market perfectly. It leads to denial of losses and overconfidence in wins. The truth is, you can be wrong often and still be profitable if your risk-reward ratio is in your favor. Losing money means I'm a failure. Losses are inevitable in trading. If you connect them to your self-worth, every trade becomes a test of your identity. This leads to emotional instability and inconsistent decisions. If I find the perfect system, I'll never lose again. This is the holy grail illusion. It keeps traders hopping from strategy to strategy instead of mastering discipline. No system eliminates losses. The market is against me. Personalizing the market creates frustration and paranoia. Remember, the market doesn't even know you exist. It's neutral. Big profits must come from big risks. This belief fuels reckless over-leveraging. In reality, consistent growth often comes from small, controlled risks repeated over time. Building empowering beliefs. Just as limiting beliefs hold you back, empowering beliefs propel you forward. Some examples include, losses are a natural cost of doing business. My edge plays out over many trades, not one. My job is not to control the market, but to control myself. Discipline is more important than prediction. Trading is about probabilities, not certainties. These beliefs align with reality. They keep you calm, disciplined, and focused on execution instead of emotions. Changing beliefs is not easy. It requires awareness and repetition. But just like any skill, it can be learned. The subconscious power of beliefs don't just guide conscious decisions, they also shape subconscious behaviors. For instance, if you believe deep down that you don't deserve wealth, you may subconsciously sabotage winning trades. If you believe money is scarce, you may cling to losing trades, afraid to waste the money by exiting. If you believe risk is dangerous, you may hesitate endlessly, missing good opportunities. The subconscious operates like an autopilot. Unless you identify and reprogram your beliefs, your subconscious will keep steering your trading toward results that match your hidden assumptions. This is why self-reflection and journaling are so important in trading. By writing down not just your trades, but also your thoughts and emotions, you begin to uncover the hidden beliefs driving your actions. Fear, greed, and euphoria. The emotional traps of trading. Every trader enters the market with hopes of profit, but along the way they face three powerful emotional forces that often dictate decisions: fear, greed, and euphoria. These emotions are not just fleeting feelings, they are deeply wired survival instincts. Left unchecked, they turn trading into a battlefield of impulses rather than a disciplined pursuit. The consistent trader learns to recognize these emotions, understand their triggers, and manage them effectively. Without this emotional mastery, even the best strategies collapse under pressure. Fear. The silent saboteur. Fear is the most common emotional challenge in trading. It shows up in many disguises. Fear of losing money. This causes traders to hesitate on valid setups, close trades too early, or avoid taking trades altogether. Fear of being wrong. This makes traders cling to losing positions, hoping the market will turn and prove them right. Fear of missing out. FOMO. This drives impulsive entries at poor prices, chasing moves after they've already happened. Fear of giving back profits. This pushes traders to exit winning trades too quickly, leaving large gains on the table. At its core, fear is a reaction to uncertainty. The market never guarantees outcomes, and the human mind resists uncertainty by imagining worst-case scenarios. The solution: accept risk before entering the trade. When you fully accept the possibility of loss, fear loses its grip. Instead of asking, "What if I lose?" you begin to think, "I've already accounted for this risk. Now I just execute my plan." Greed, the endless hunger. If fear holds traders back, greed pushes them too far. Greed is the desire for more, often without discipline or logic. It manifests in several ways: adding to winning positions impulsively without a plan, ignoring profit targets, hoping for even bigger gains, taking oversized positions to maximize returns quickly, jumping into every trade setup instead of waiting for high-quality opportunities. Greed creates recklessness. A trader may double or triple their risk after a win, convinced that they're on a streak, but the market punishes overconfidence swiftly. The solution: predefine goals and stick to them. When you decide in advance how much you're willing to risk and how much profit is enough, greed has no room to hijack your decisions. Euphoria, the most dangerous emotion. Fear and greed are obvious enemies, but euphoria is a subtle one. After a string of winning trades, traders often feel invincible. Their confidence turns into arrogance. They stop following their plan, over-leverage, and believe they can't lose. Ironically, many of the worst losses in trading occur right after a winning streak, because euphoria blinds judgment. The solution: stay grounded. Remind yourself that wins don't make you invincible, just as losses don't make you a failure. Consistency comes from sticking to the process, not from emotional highs. Recognizing your emotional patterns. Every trader has unique triggers for fear, greed, and euphoria. Some traders panic after small drawdowns, others overtrade when they feel confident. The key to mastery is awareness. Practical steps. Keep a trading journal. Record not only trades but also your emotions and thoughts during them. Look for patterns. Do you hesitate after losses? Do you over-leverage after wins? Create counter rules. If you tend to chase after missing a trade, set a rule to pause for 15 minutes before entering another position. Awareness creates control. You cannot eliminate emotions, but you can stop them from dictating your actions. The probability, mindset, randomness versus patterns. One of the biggest mental hurdles in trading is accepting that markets are both random and patterned at the same time. On the surface, price movement often feels random. Prices jump up, drop down, or move sideways without any obvious why. Thinking in probabilities matters. Imagine you flip a coin. You know the probability is 50% heads and 50% tails. If the coin lands on tails 5 times in a row, do you panic? Do you think the coin is broken? Of course not. You understand that streaks happen within a larger distribution. Trading is the same. A strategy with a 60% win rate will still have losing streaks. Sometimes you'll lose 5 trades in a row. Sometimes you'll win 10 in a row. Neither streak changes the underlying probabilities. But here's the trap. Most traders don't treat trading like a probability game. They take a loss and feel personally attacked. They take a win and feel like geniuses. They judge themselves by individual outcomes instead of the larger series. The probability mindset frees you from this trap. You stop caring about any single trade. You start thinking in terms of samples, averages, and long-term outcomes. Accepting losses is natural. One of the hardest truths in trading is this: losses are unavoidable. No matter how skilled you are, no matter how sophisticated your system, you will lose trades. The probability mindset teaches you to embrace this reality. Losses are not failures. They are not proof that you are a bad trader. They are simply part of the statistical distribution. Think like a casino. Casinos don't cry when a player wins big at the roulette wheel. They know that over thousands of spins, their edge guarantees profit. A single loss means nothing. When you adopt this mindset, losses stop triggering fear and frustration. They become just another business expense, like rent for a store or fuel for a delivery truck. You accept them, move on, and focus on the next trade. Risk and reward thinking. The probability mindset also reshapes how you view risk and reward. Instead of asking, "Will this trade win?" you start asking, "Does this trade give me favorable odds?" Example: suppose your system gives you trades with a 50% win rate. If you risk $1 to make $2, you only need to win half the time to be profitable. Over 100 trades, you might win 50 and lose 50. That's $100 in profit from a $0 predictive edge, because your risk-reward ratio did the heavy lifting. Consistent traders always calculate risk and reward in terms of probabilities. They know that even if they lose several trades in a row, the math will balance out as long as they follow their system. The trader's edge. What is an edge? In trading, an edge is the small but consistent advantage that makes you profitable over time. It's not about predicting the market perfectly. It's about stacking probabilities in your favor. Think again about casinos. Every game in a casino is designed with a mathematical edge. For example, in roulette, the house edge might only be 5%. That means players can win in the short term, but over thousands of spins, the casino is guaranteed to profit. Traders must think the same way. Your edge is not a guarantee that a trade will win. It is simply a higher probability of success compared to random chance. Over time, this small edge compounds into consistent profits. But here's the problem. Many traders never define their edge. They jump into trades because of intuition, news, or impulse. Without a clear edge, their results are random, and random trading is gambling. The illusion of the Holy Grail. Most beginners believe there's a Holy Grail system, a strategy that never loses. They search endlessly for the perfect indicator, algorithm, or signal. They test one system, experience a few losses, then abandon it for another. This cycle repeats until they're exhausted and broke. The truth is, no edge works all the time. Even the best strategies produce losses. What separates professionals from amateurs is not the system itself, but the discipline to stick with it long enough for the probabilities to play out. Your job is not to find a holy grail. Your job is to define an edge that gives you positive expectancy and then execute it with discipline. Expectancy. The math behind an edge expectancy is the formula that measures your edge. It answers the question, how much can I expect to make or lose per trade on average? Here's the formula. Expectancy. Win rate X average win. Loss rate X average loss. Example. Win rate SIRE 50% average win. Or 200 loss rate SIRE 50% average loss. $100 expectancy SIRE 0.5x 200, 0.5x 100, or SIRE 100, $50 per trade. That means over 100 trades, you can expect to make about $5,000. Even though you'll lose half the time. This is the power of an edge. It's not about being right more often. It's about making more when you're right than you lose when you're wrong. Why discipline is essential to an edge. An edge is useless without discipline. Imagine a trader with a profitable system that requires a stop loss of $100. One day, they ignore the stop and let the loss grow to $500. That single mistake may erase the profit from 5 winning trades. The system had an edge, but the trader destroyed it by breaking the rules. This is why professional traders often say, the edge is not just in the system, it's in your ability to execute it flawlessly. Consistency of execution is what allows the statistical advantage to play out. Without discipline, you turn a winning system into a losing one. Building confidence in uncertainty, confidence versus certainty. Most traders confuse confidence with certainty. They think confidence means knowing for sure that a trade will work. But in reality, certainty does not exist in the markets. No indicator, no system, no analysis can guarantee an outcome. So what is real confidence in trading? It's the ability to act decisively despite uncertainty. Confidence means you trust your system, your risk management, and your ability to execute, even though you know any single trade can lose. It's not about believing that this trade will win. It's about believing that over many trades, you will come out ahead. This distinction is critical. Traders who demand certainty hesitate, overanalyze, and second-guess themselves. Traders who embrace confidence act with clarity, knowing that the outcome of any one trade doesn't define their success. How lack of confidence sabotages. When traders lack confidence, they fall into destructive cycles. Hesitation, they see a valid setup but freeze, waiting for more confirmation. By the time they act, the opportunity is gone. Overanalysis, they pile on indicators, read endless news, and keep adjusting charts, searching for the impossible, perfect signal. Second guessing, they enter a trade, then immediately doubt themselves and exit too early. System hopping, they abandon their strategy after a few losses and chase the next holy grail. All of these behaviors come from the false belief that confidence equals certainty. When certainty doesn't exist, they crumble. The consistent trader knows confidence is built not on outcomes but on process. Trusting your system to build confidence, you must trust your trading system. This trust doesn't come from blind hope, it comes from evidence. Backtesting, analyzing historical data to see how your strategy performs. Forward testing, trading small size in real time to prove the system works under live conditions. Journaling, recording trades to track consistency and results. When you see evidence that your system produces positive expectancy, you stop caring about individual outcomes. A losing trade doesn't shake your confidence because you know the system wins in the long run. Confidence grows from proof. The more evidence you gather, the more you trust the process. Confidence through risk management. Even the best system will produce strings of losses. Without proper risk management, these drawdowns can destroy not only your account, but also your confidence. This is why professionals risk small amounts per trade, usually 1–2% of their account. By keeping losses controlled, they protect themselves from emotional devastation. Confidence comes from knowing no single trade can ruin me. A losing streak will not wipe me out. My account is safe enough to keep playing the game. When you manage risk correctly, fear fades and confidence rises. Conclusion. Final message. Trading is not just about charts, numbers, or strategies. It's about mastering your own mind. If there's one lesson from trading in the zone, it's this. Success in the markets comes from discipline, patience, and confidence in uncertainty. Every trade you take is a reflection of your mindset. Learn to detach from fear, greed, and the need for certainty. Build trust in your edge, manage your risk wisely, and most importantly, stay consistent. Remember, losses are not failures. They are simply the cost of doing business in the world of trading. As long as you follow your plan with discipline, the probabilities will work in your favor over time. And before you go, if you found value in this journey, please don't forget to like this video, share it with your friends, and subscribe to my channel, Ocean of Thoughts. Your support inspires me to keep bringing more powerful insights, lessons, and stories that help you grow in trading and in life. Until next time, stay disciplined, stay focused, and always trade with a clear mind. This is Ocean of Thoughts signing off.